We just got the latest inflation data, and what it says is that inflation is cooling, and we now have the lowest rate of inflation since early 2021, back when the Federal Reserve Bank said that inflation was transitory. But there are some interesting pieces of data that we got from this inflation report that I think you'll want to know. Number one, what it said is that CPI, headline inflation, rose by 2.5% over the last 12 months. Number two, it also said that incomes are now rising faster than inflation. And number three, it said that core inflation, which is the inflation number that the Federal Reserve Bank likes to look at, that's when you take the headline inflation, the broad inflation number, and then you remove what they call the volatile numbers, energy, food, that came in slightly higher than expected. And because of these three things, this is where now Wall Street is predicting that number one, the Federal Reserve Bank is still going to cut interest rates next week on September 18th when they meet. But number two, instead of doing a big 0.5% interest rate cut, they're now expecting the Federal Reserve Bank to do a 0.25% interest rate cut, also known as a 25 basis point interest rate cut next week, because we saw this slight rise in core inflation. So what I want to do in this video is go over three things. Number one is I want to break down what's going on with inflation right now. Number two is I want to break down what's going on with the jobs market, because the Federal Reserve Bank is also paying close attention to what's happening in the labor market, the job market. And number three is I want to go over what this means for you. So starting with the inflation numbers, let's go over where inflation is and where inflation is not. The top three places where inflation is, the top hottest inflation areas, according to this data, is number one, car insurance prices have risen the most. Number two, housing costs. And number three, the cost of eating at a restaurant. And the three areas where inflation's fallen the most, where we're seeing deflation, is number one, used car prices. Number two, gas prices. And number three, rental car prices. But what I want you to remember here, when it comes to inflation data, we've also covered this in market briefs, is that inflation is a compounding number. So the inflation that we're seeing today in 2024 compounds on top of the inflation we saw in 2023, which is on top of the 2022 inflation, which is on top of the 2021 inflation. And so when you get the reports now saying that wage growth is higher than inflation, as if now people are suddenly making more money and they can afford everything, I want you to take that with a grain of salt. And the reason why is because if you remember, between 2021 and 2023, the reported inflation numbers were here and wage growth was here, which meant we had this big time period for a few years where reported inflation was significantly higher than wage growth. And notice I'm saying reported inflation, I'm saying that for a reason. Now what we're seeing happen today is that reported inflation is here and wage growth has gone up to here, slightly higher than the reported inflation. And this is where now you have a lot of economists saying we have won the war on inflation, because now people are seeing their incomes rise faster than inflation, which is great for today, but it doesn't make up for the big price gains that we saw in 2023 and 2022 and 2021. And so you have to remember that inflation is a compounding number. So when you hear that inflation is 2.5% and that inflation is cooling, that doesn't mean that the prices of things are falling. It means that the prices of things are rising, not as fast as they were before. And even if the prices of incomes have risen faster than the prices of things recently, that's good news. But that doesn't mean that people can suddenly buy more stuff like they could 5 years ago, because we saw a big chunk of time where inflation was outpacing wages. However, if we continue down a trajectory where wages continue to rise faster than inflation, then that could correct that. But there's one problem with that. The problem is reported inflation is different than real inflation. Real inflation is the inflation that you actually feel. Reported inflation is the inflation numbers that all the statistics show you. And many times the real inflation that people are feeling is higher than what the reported numbers will tell you. Because according to the reported numbers, we have seen the prices of things rise by an average of 25%, actually less than 25% over the last 5 years. But if you ask the average person, you're paying more than 25% more on your groceries than 5 years ago. You're paying more than 25% if you want to go out and lease a new home or buy a home compared to 5 years ago. You're paying more than 25% more when you go out to really buy anything compared to 5 years ago. That's why there's a difference between real inflation and reported inflation, because the reported inflation is really just an aggregate of a bunch of inflation numbers, but the real inflation is the actual inflation that you're feeling. That's what you want to remember. Now, of course, if you want to stay up to date on what's happening in the financial markets when it's happening, you can join Market Briefs. Market Briefs is a free financial newsletter that I created, which keeps you up to date on what's happening in things like the economy, the housing market, the stock market, crypto, and the global economy into a fun, witty, and easy to read newsletter. You can read it in less than 5 minutes every morning, and it's completely free. So if you have not joined Market Briefs yet, I got the link to how you can join down in the description below. And we also have more confirmation from the Federal Reserve Bank to say that interest rate cuts are coming. Remember, the Federal Reserve Bank is meeting on September 17th and 18th. On September 18th, they're going to make their announcement as to what they want to do with interest rates. And the Federal Reserve Bank has said multiple times now that it's time to start cutting interest rates. What the Federal Reserve Bank Governor Chris Waller said is that, number one, quote, "I believe the time has come to lower the target range for the federal funds rate at our upcoming meeting. The time has come to start cutting interest rates." What does that mean? You can expect that the Fed is going to start cutting interest rates, and they were paying attention to this inflation report to see if they should cut it by 0.25% or 0.5%. And based off of this data, it seems like Wall Street believes that the Fed is going to cut interest rates by 0.25%. Which brings me to the topic of job growth and jobs. And the reason why I want to talk about this in this video is because the Federal Reserve Bank follows what's called a dual mandate. That means they pay attention to two things. They pay attention to price stability, and they pay attention to maximum employment. That's just a fancy way of saying they pay attention to inflation and unemployment numbers. We just discussed inflation, that the rate of inflation has been falling, but of course, it's still a concern. And this is why now the Federal Reserve Bank believes that they can start cutting interest rates because inflation has been falling, or the rate of inflation has been falling. But then on the other hand, you have the job market. And this is where the Federal Reserve Bank is starting to get more concerned because we have been seeing the job market cooling for a number of months now. And for the last number of months, every time we got a job market report, it's been a very similar story where number one, we find out that employers are hiring less people than expected. We're seeing more layoffs than expected, and we're seeing a steady cool down in wage growth. Yes, at the same time, the inflation data is saying the incomes are rising faster than inflation. We're still steadily seeing wages slow down. The reason why this is significant is because the Federal Reserve Bank sees this and they're saying, maybe we need to start cutting interest rates as a way to stimulate the economy, as a way to stimulate the job market so it doesn't get worse. And so it doesn't potentially go into a recession. And this is what the Federal Reserve Bank is actively working to avoid. They want to avoid that economic pain because that doesn't look good on their part, because they want to keep the economy strong, they want to keep people employed, but they also want to keep inflation at bay. And this is where it is a tough kind of thing to balance, because if you raise interest rates significantly, you can cool down inflation, but then you can break the job market. And if you start cutting interest rates, well, now you can make the inflation problem worse, because you got to imagine, if housing is one of the top sources where inflation is, remember, housing is number 2 on the highest inflation places right now, right below auto insurance. Housing is also one of, if not the most sensitive area to interest rates, because when interest rates go down, your mortgage rate becomes cheaper, more people want to go out and buy a home. And if the Federal Reserve Bank starts cutting interest rates and mortgage rates start to go down, let's say in the next 6 months we see mortgage rates fall by a couple percent, you got to imagine that there's going to be a number of potential home buyers that are going to say, I've been sitting on the sidelines, not wanting to buy a home because I couldn't afford a mortgage payment, but now I can borrow $500,000 because it's going to cost me less interest. Because as interest rates go down, your mortgage rate goes down and you can borrow that money at a cheaper rate. And so if more buyers wake up and say, maybe I should go out and buy a home now, well, that could make more offers on homes. So if you list your home for $500,000, now maybe you get 7, 8, 9, 10 offers as opposed to 2. And if you start to get more offers, that could create more bidding wars, that could push home prices higher. The problem with that is that can make the inflation problem worse. So if you're thinking about buying a home, yeah, maybe you can get a lower mortgage rate, but that could mean that you have to borrow more dollars. Again, we don't know, because you have to imagine that the Federal Reserve Bank would think about this, right? I mean, they have been wrong in the past. They said inflation was transitory and other things like that, but you have to imagine that they've thought through that if interest rates go down, more people are going to buy homes, which could make home prices go up, which could make the inflation problem worse, and that's what they want to avoid. But you have to think that they've thought through this. So the question is, are they concerned about an economic slowdown or a recession which would hinder people's abilities to buy a home? And that's what you want to pay attention to, because obviously we don't know, which brings me to what does this mean for you? I did an interview on this very topic yesterday. And what you want to remember is that every single person has an opinion about what's going to happen in the markets. But financial opinions are like armpits. Everybody's got a couple, and some stink more than others. Listening to somebody's opinion, trying to predict what's going to happen, trying to predict if there's going to be a housing market crash or a housing market boom or a stock market crash or a stock market boom, it doesn't do you any good, because nobody knows what's going to happen tomorrow, let alone the fact that we have the X factor, which is of course the government, that could interfere. I mean, when markets were crashing in 2020, we saw the fastest stock market crash in the history of time, and then the Federal Reserve Bank opened up the money printer, and it went from the fastest stock market crash in the history of time to the fastest stock market rally in the history of time. We saw both of those headlines in a matter of 6 months in the year 2020. So it's very difficult to predict what is going to happen in the markets, but what I want for you is to be able to understand what's happening, that way you can capitalize on whatever is happening. I want you to be able to win no matter what's happening in the markets, because the reality is no one knows what's going to happen tomorrow, let alone a year from now or 2 years from now. Do we have red flags in the economy? You bet. Is there uncertainty? You bet. We also have an election year. All these things create uncertainty. But what you want to look for is the opportunity. And you want to make sure that you are financially prepared to be able to capitalize on the opportunity. That means be smart with your money. Don't spend all of your money on dumb things. Have money aside to invest. Learn about investing. Learn how to read a financial statement. Learn how to analyze an investment. Learn about index funds, ETFs, mutual funds. Learn about real estate investing. Start investing your money. And then pay attention to the financial trends, because that's going to show you where the real opportunities are. Because if you understand that, then you're going to have the ability to build wealth for yourself regardless of what's happening, because you don't want to get caught up in the financial noise. You want to find the opportunity, because emotions are the enemy of profits, especially when it comes to your investments. And with that, I will see you tomorrow on YouTube.